Hey there, everyone. Welcome to this special edition of The Final Bar. We get a lot of great questions in our mailbag, and one of the questions I often get relate to some of the indicators that we share on The Final Bar. As you know, our goal with The Final Bar is to talk about what's happening in the markets, but really put it into proper context. We talk about the benefits of technical analysis as a way to help you make sense of things, to really improve your market awareness by focusing on the evidence the market provides back to us in the form of price and trend and momentum and all those other inputs. So I wanted to share with you today one of the charts that I use pretty much every episode, often a number of times, and through the course of the week, probably about 1,000 times a week, I would guess. I'm bringing up some version of the chart I'm about to show you. So today what we're going to do is a special edition focusing on the chart, right? The key three indicators that I think every investor should be following. I don't want to guarantee that these are the right indicators for you, and that's something we'll talk about. It's all about what's going to help you best answer the questions you are trying to answer as an investor, but I'll share with you how I decided on these indicators for my own process. And let's get to today's very important pro tip. Let's focus on some of the technical indicators. Again, the Stock Charts platform has literally hundreds of different technical indicators to use. So how do you figure out which ones you want to pay attention to, right? Which indicators should you use? Well, as you watch the show, as I bring on all the different guests, you'll note that every one of them pretty much has a different chart. Some very dramatically different, showing wave counts or different sort of cycle patterns. Some of them very similar, focusing on the messages of trend and momentum that we talk about often on the show. But the reality is everyone's sort of go-to chart, your main chart style, to put it in a Stock Charts vernacular, is always a little bit different. So how do we find those indicators, and how do we settle into them? Well, I'll share with you the ones that I use, why I use them, and how I use them. We'll look at an example, Intel, which is a great kind of plain vanilla, kind of average stock in the technology sector, just to show you how we can use these indicators as a checklist. And that is a key, that's sort of the essence of this pro tip, the checklist that we're going to follow to qualify the entry and exit points that we think are most important to us. So just to get oriented, this is my main go-to chart on Stock Charts. I'm bringing up Intel, and I have a series of indicators. I'm looking at a 2-year daily period. And so first off, I would remind you that the type of period that you use, daily, weekly, hourly, 5-minute, the amount of time you bring in, 1 week, 1 year, 1 decade, is all about the time frame, right? So in general, what I try to tell people is think about what your investment horizon is. For me, it's about 1 to 2 to 3 months or so on average, generally speaking. So I usually say like 6 or 7 times that amount going back in history is kind of the general starting point I would go with, right? So if I'm looking at, 2-3 months out, I would say 6 or 7 times that means about 18 to 21 months. So I round up to 2 years, which is an easy time frame to pay attention to. So think about how forward you're tending to look, and then back up about 6 to 7 times. That's a good starting point. Kind of tweak it from there. So on my 2-year daily chart, I'm doing the open, high, low, close bars. And then I have the 50 and 200-day moving averages. That's the first set of information we're going to talk about. The 50-day moving average, of course, is simple average of the last 50 closing prices. The 200-day, the same thing for the last 200 closing prices. Below that, I have RSI, which is my favorite measure of price momentum. If you think about it, the day-to-day movements are pretty noisy. So we can either smooth out the movements in the day-to-day action using a moving average, or we can kind of standardize it, right? Sort of look at more of a normalized version of the change in this stock. So things like rate of change and other sort of oscillators fit into that general category of trying to make sense of what we're doing right now relative to what we usually do for this stock. RSI, I'll get in briefly into the calculations, is an indicator created by Wells Wilder to basically define price momentum. How strong or weak is the price action? Finally, we have what I would say is probably the most important indicator of everything I'm going to show you, which is relative strength or relative performance. This is based on a ratio of the stock that you're looking at versus a benchmark, or whatever you want on that denominator. It could be a sector, it could be another stock, it could be whatever helps you make sense of how this stock is moving versus some other lever you could be pulling. So for most investors, I usually encourage them to start with the SPY. Grayson Rose, one of our other Stock Charts experts, uses the VTI, which is a broader equity benchmark. I think whatever is sort of that main asset class, right? For most investors, the SPY, but whatever you're sort of comparing your performance against, that's what you want to put there, because we're basically looking for things that are outperforming our benchmark or outperforming a passive asset class or ETF that we might want to choose. So that is how we've set the table here. I'm going to go through each one of these indicators in a little more detail and talk through this example with Intel and encourage you to experiment on your own to think about which indicators you want to include. I'll also at the end show you how you set up this chart, in particular on stock charts, why we save it as a chart style, what that actually means on our platform, and where you can find more information about all the different technical indicators out there. So starting from the top, I would always say you start with an analysis of price, right? And so the first thing on my checklist, any checklist I've ever written about analyzing the markets always starts with price. And we talk often on the show about the what's called Dow theory, Charles Dow's original work from the early 1900s, where he defined trends based on the patterns of the highs and the lows. So an uptrend is a pattern where the high prices are getting higher and the low prices are getting higher. A downtrend is a pattern where the high prices are getting lower and the low prices are getting lower. What I often say, higher highs and higher lows, that's an uptrend. And you know, my 7-year-old son, Henry, I always joke, whatever, if I showed Henry the chart, what would he say, right? Is this stock going up or down? And what Henry is probably doing, even though I haven't taught him much about technical analysis, he's looking at the trend, right? He's just looking at the pattern over time, not getting caught into the weeds, but just looking at the overall trajectory. So a trend that Henry, my son, would recognize are the types of trends that you want to immediately recognize and base all the rest of your analysis on that simple and first assessment of the trend characteristics. So at this point, what's the trend in Intel? Well, it depends on your time frame a lot of times, right? So I highlighted in September and October of last year, we're actually making a pattern of lower highs and lower lows just for this little short-term time period, what you probably call a bull flag pattern, but then we eventually went higher. So I would always sort of suggest take a step back, either literally or figuratively from your monitor, and just look at the pattern in the highs and the lows. Now, if you're not comfortable doing that, or if you find that to be a challenging exercise, on stock charts, we have a really simple but powerful indicator called zigzag, and this bases the indicator on a percent change, and you can customize it. It defaults on this chart to a 5% range. It actually adjusts it based on the volatility of the chart when you first bring it up. But this basically automatically detects the swing highs and lows and puts the little green line here to identify those. So are the zigzag indicators going up or down is kind of what you want to do. And if you find it's a little too noisy, you want to bump up the percentage to something a little bigger. If you find it's not noisy enough, it's a little too, capturing these big, broader moves, then make the percentage smaller because the percent swing is what it's trying to capture. Here I made it a 10% swing, which for me is kind of a nice way of illustrating the sort of general long-term trend that I'm observing on the chart of Intel. Now, I tend to do that visually, so I think of the zigzag indicators a little too noisy, so I'm taking it off for now. All right, so below there we have moving averages. Why do we look at moving averages? Why am I using these two particular ones? So I use the 50-day moving average in blue, the 200-day moving average in red. And the reason why we use moving averages is because the day-to-day movements in any financial asset are noisy. The markets are noisy. There are a lot of little wiggles and squiggles that, to be honest with you, have very little bearing on the overall trend in a particular stock. We want to focus more on the big picture and the overall trend. So what moving averages do is they smooth out the price movement. It's a very simple way of doing it. They're called simple moving averages. The 50-day moving average is a simple average or a mean of the last 50 closing prices. So you add up the last 50 closes, you divide that by 50, there's your number. The 200-day moving average, obviously a larger period of time, takes in more time period or more of a time frame into account. As a result, it's more of a smoother trend in the price action. So why do we use moving averages? Well, I'll tell you one of the ways you can see the benefits of moving averages is by taking this setting down here. And man, tell me in the comments how you think you pronounce this word, opacity. Opacity, I will go with, although I have no idea. You take this as basically how opaque it, right? How transparent or opaque that the price action is. I'm going to take it all the way down to 0, which basically takes the price out of the image. And now I'm just looking at the moving averages. This shows you why we pay attention to the direction of the moving averages, right? The 50-day moving average basically sloping lower through the first third of the chart. In the middle third, it's sort of sideways. And then you can see on the right, the final third, you can see that the 50-day moving average is sloping upwards. In red, we have the 200-day moving average, which was sloping downwards really through the summer of last year, then started to slope higher, right? So the trend here is down. As defined by the fact that the two moving averages are sloping downwards. I would say the trend is in flux when the 50-day is flat and it crosses the 200-day, and the trend is clearly positive when the 50-day is over the 200-day. let's put the price back and you can see why that is a really good way of sort of minimizing the noise here, right? Once we put the daily price action, look how choppy all of the normal data feels. But we have the same general assessment, right? We're in a downtrend in the first third, sort of in a consolidation in the middle of the chart, and then in a clear uptrend in the upper end of the chart. That's one of the, I guess, mini pro tips I'll share with you today. Taking this value down to zero and just looking at the shape of the moving averages can be a great way of disconnecting from some of your preconceived biases. And I would encourage you to set up a series of charts just with moving averages and no price. Go through that list and see if anything surprises you, particularly with current holdings, right? Put stocks and ETFs that you hold into a chart list, get rid of the price, and just look at the shapes of the moving averages. A lot of times some bad charts will become a lot more obvious when you just simply look at the slopes of the moving averages. So in this case, the price is above two upward sloping moving averages. Obviously, they're trending higher. The 50-day is above the 200-day. That is a trend that's pretty positive. And so generally speaking, that's the type of chart that I want to hold in a portfolio, stocks that are going up. And you define going up by the trend, sort of the Henry check are the highs and the lows going higher, and then the slopes of the moving averages, in this case, all sort of constructive. So the trend that I'm concerned with on Intel, pretty positive, right? Overall, pretty constructive price action over time. Now, there are a lot of nuances with how we use the moving averages, and maybe we'll do subsequent videos with some more pro tips teaching you about moving average techniques and different ways to use them, different types of moving averages. But for now, that's the basic way I would start with it. And if you're just getting started, that should get you going. And as always, look where the price is relative to those key moving averages. Now, below that, we have RSI, the Relative Strength Index. This is a measure of price momentum. As I mentioned, Wells Wilder, back in the 1970s, did some really fantastic work and created a number of indicators that we think of as very sort of common, sort of in the general body of knowledge. RSI, DMI, the ADX line, parabolic studies. These are all things that came from one book that Wells Wilder wrote in the 1970s called New Concepts in Technical Trading Systems. I'd encourage you to pick it up because it actually is this big format, like an 8.5 by 11 book. It has his handwritten notes in an accounting ledger where he literally hand calculated each of those indicators. So if you want to understand what the indicators are, how they're calculated, and how he envisioned them being used, go to the source, Wilder's book from the 1970s. Really interesting, and certainly made me think about it. And I should note that early in my career, one of the I guess penalties, I was told it was a learning opportunity, but I was required in my Bloomberg days to prove out all the indicators that we had in Excel. So I literally had to recreate them using the raw price data. It was a pain in the behind to do it, but I learned a ton and really learned about the mechanics of each of those indicators and what types of things you were trying to do. So if you really want to make a task for yourself, but learn some of these indicators better, that's a good way to do it. So when I was looking at RSI, I was immediately drawn to the fact that it basically standardized the price movements. And if you know statistics, this is basically like taking a z-score of the price action. It's not exactly that, but if you know statistics, think of it that way. It'll give you pretty close to what you're doing. It's a way of just getting rid of the larger trend direction, just kind of looking at the overall momentum, right? How are we moving recently versus how we normally move? Now, the way that this indicator is calculated, we actually had a question in the mailbag about this just in the last week. It basically looks at the average up day versus the average down day. So it starts with a 14-day look back or whatever you're using here, and it says, all right, for the last 14 days, when we closed higher, how much higher did we tend to go? When we closed lower, how much lower did we tend to go? And so it's a ratio of the average up day to the average down day. And that's it, right? So when the stock closes up, how strong is that kind of day? When the stock closes down, how low is that kind of day? Or how weak or how strong is that down day? So if you think about it, the higher the RSI, the stronger the up moves, the more bullish the price action. The weaker the RSI, the stronger the negative price action, the stronger the down days, we're probably going down a lot. Now, if you think of it that way, and there is an exponential calculation, which I'm not getting into because the math's a little too much for this video, but there is an exponential calculation that smooths it out a little bit more. So it's not a raw version of that. It actually uses an exponential calculation. I'll show you later where you can find the actual calculations that are used to create the indicator. But the reason why this makes sense is because when a stock is going higher, like Intel in November and December, the RSI tends to be high. So it tends to be above 50 in general. And it often will get to that overbought region. And when a stock becomes overbought or an ETF becomes overbought, that usually coincides with short-term peaks in the price. And the reason is because we've gone too high too quickly. We're now overbought. We're not just going up, but we're going up a little too much relative to what we normally do. And you usually expect a bit of a pullback. So if you look at when simply the RSI is overbought, you often have a brief pullback. Even though the longer trend has been up, you often have a brief pullback out of that overbought region. So you want to look for when the RSI comes out below 70, and that's when it usually tells you that a pullback is sort of happening. So on a lot of these names that had really good runs at the end of last year, one of the main things I was looking at was the overbought conditions on a lot of these, and just expecting at least a brief pullback at the beginning of the year, which we certainly had in the first week. But if you look, the trend, of course, has still been very positive here in November and December. And look at the overall shape of the RSI. We've become overbought on rallies, and we've not gotten much below 50 on pullbacks. And I usually think of 40 as kind of my downside threshold during a bullish phase. So if the RSI is getting below 40 when we pull back, that tells you we're not really in much of an uptrend. If the RSI gets only down to 40 on a pullback and then pushes higher, that probably means the longer term trend is up. And if you naturally extend that logic I'm just sharing with you, if the RSI often becomes oversold when we sell off and doesn't get much above 60 on rallies, that tells us we're probably in a downtrend. So by looking at the RSI value, looking for overbought, oversold conditions, by looking at the overall range of the RSI, do we tend to be above 50 or below 50? And are we overbought or oversold? And how is that trending over time? Also divergences, and Intel does not have a divergence right now, but a stock like DR Horton just had a bearish divergence, right? Higher highs in price, lower peaks in momentum, and that often happens at the end of an upward trend. So recognizing those parts of RSI basically tells you, now that we've had a basic assessment of the trend in Intel or whatever stock we're looking at, what can the RSI tell me to qualify my assessment of that price action by normalizing the price movements and thinking about the general trend of the up days and down days? Can I get some additional color as to what may come next in the form of the next move in price? So now we've talked about price, moving averages, RSI. The very bottom that I use is relative strength, or what's called relative performance. There are a number of names for this. People have called it internal strength, relative strength. RSI is the main name of, relative performance is another way we refer to it. It is not the relative strength index, and again, that's just a horrible naming convention. On behalf of technical analysts past, I apologize for the fact that these indicators are named way too similar because it causes a lot of confusion. RSI, the relative strength index, isn't relative to anything else except itself, right? The idea is, what are the current movements relative to the normal movements, so you can find extremes. But relative strength, or true relative strength, relative performance, is where we're looking at this stock versus other stocks out there. And we usually use this or express this as a ratio. So I do Intel versus the SPY. And I would encourage you to start with that as your denominator if you don't have a better answer for that. The reason why you'd use other denominators, when I worked with money managers that had a very particular benchmark, like the Russell 2000 or the Russell 1000 Growth Index, or a sector index, right? They're trying to outperform the energy sector. We would use that as the denominator because their goal was to outperform that benchmark. For most investors based in the US, your benchmark is probably the S&P 500. That's a good starting point because you have two general choices as an equity investor in the US. You can just buy the SPY and go to the beach and sort of chill out and not worry about the markets. But if you want to manage things actively, which I do think is a good option if investors and traders have enough time to devote to your market awareness, then you want to outperform the S&P and you want to own things where this line is going up. Now, why is that important? One of the great ways, great arguments for using relative strength comes from a friend, and I would consider a mentor, John Roque. He was at a number of firms. He's now more on the buy side in the hedge fund community in New York, but he came up to Boston when he lived in New York as a lifelong Yankees fan, came up to Boston where I worked with a bunch of Red Sox fans. I was not comfortable with either of these groups, by the way, in terms of their selection of sports teams. However, he came up and told a group of Red Sox fans, all right, Yankees are playing the Red Sox tonight. You want to beat the Yankees. Who are you going to put on the field if you're managing the Sox today? Are you going to put your best players who are hitting well and are on a hot streak and are really performing at their peak? Or are you going to put the guys on the bench that are struggling, that are not really hitting well? You obviously would want to put your best players to give yourself the best opportunity to beat a rival team. So why would you do anything less for your portfolio? That was his general way of describing that. And if you think of that analogy, it'll probably point you to the right things, right? Strength tends to beget further strength. Certainly if you're looking a couple months plus down the road, Stronger charts tend to get stronger, weaker charts tend to get weaker, and then there's a very clear inflection point when rotation happens. That's where things like the RRG that Julius de Kempener created can be very helpful at identifying. So looking for stocks and ETFs where this line is generally trending higher tends to be a good thing. So if you think about what we've now assessed, the trend in Intel is going higher as defined by the higher highs and higher lows. The moving averages are sloping higher and the price is above 2 upward sloping moving averages, which tells me that the longer term trend is pretty constructive. The momentum is strong, but not excessive, right? The RSI is consistently above 50, which tells me we're in a bullish phase, but we're not overbought yet, which tells me a chart like Intel probably has a little more room to run before we might get to that point where I'd expect a brief pullback after a period of excessive strength like you saw in mid-November or late December. We're not in that pattern here. I actually suggest that there's maybe some further upside potential. And then finally, the relative strength line or the relative performance has been trending higher for the last 6 months, which tells me not only is Intel going up, but it's going up more than the benchmark. So by owning Intel over the last 6 months, I've outperformed a passive vehicle like the S&P 500. That is top to bottom how I set this chart up and how I think of it, and how I just described it as looking at price, then moving averages, then momentum, and then relative strength. What I've done is basically lay out a very simple checklist. Now, this isn't all that I include on my checklist. I actually have 7 things that I include on my checklist. Maybe the subject of a future video to go through that in a little more detail. But this is the way that I would think of technical indicators. Don't feel that you need to find that one indicator. A lot of early investors just learning technical analysis think, all right, if I can find that holy grail, that one thing, and all I need to do are follow the buy and sell signals, I'm done. I think unfortunately a lot of practitioners sell that idea that, all right, here's that one indicator you need to follow, just follow this thing and you're good. In my experience, technical analysis is not that, right? Nothing is 100% accurate despite what you might hear, and certainly 80 or 90% accurate is actually incredibly unusual. In general, you're wrong a lot, but what you can do by using a disciplined process and a systematic process of going through these items on your technical checklist, I think you could actually do quite well on a relative basis over time. So think of it in that order. Start with price, go to moving averages would be my next suggestion, and then add some additional indicators that help you along the way. To finish off here, let me talk to you about how we can select the indicators that are included on the chart, why I have this set up as my default chart style, and then we'll wrap it up for this episode of The Final Bar. So how to find indicators like this? Well, I will tell you, if you're confused at all by what I told you about RSI, if you really want to understand relative performance or best practices with moving averages, 2 things I would suggest to you. Number 1, click on the magnifying glass, type something like RSI. You want to make sure you're looking at the chart school portion of our website when the results come up. But once you do that, you'll find a lot of really well designed articles with beautiful examples that show you all the different things we were talking about, how the indicator is calculated. So we'll show you the formulas. We'll also show you some other things as well. Let me just get to that article here. So I'm going to the Chart School articles, Relative Strength Index. What is the Relative Strength Index? There's Wells Wilder talking about that. Here's the book that I mentioned, New Concepts in Technical Trading Systems. There's the actual formula, including the exponential average that we use to smooth out the data over time. And then you can see some of the examples that show you overbought and oversold conditions, divergences, and so forth. So the Chart School portion of our website is a fantastic resource. When I was learning technical analysis a couple of years ago, I used the Chart School portion of stock charts to learn a great deal. I would also tell you the second thing, if you're trying to learn technical indicators, go to the articles tab, because you'll find that a lot of our commentators use technical indicators and use them on current examples. So you'll find how people like Miss Schneider and Julius de Kempener and Mary Ellen McGonigal and others are actually using these indicators real time, every trading day, trying to make sense of these markets and identify stocks and ETFs with upside potential. Now, not all of them use the same indicators. All of their charts actually look a little bit different. But by going through the articles page, looking at how they're actually using the charts and drawing beneficial conclusions from them, I think it could help you make some better decisions as well. Now, I also mentioned the chart that I was using, which is this chart of Intel. How do we set it up? Below the chart, and if you hit pause on the video, you can look down at the settings that I have here. Mimic the settings that I have, and you will get the exact same chart. I will actually put a permalink. We'll put a link in the description of this video so you can actually go right to the Stock Charts website. Start with this. I would encourage you, if you don't have a great chart to start with, go with this one and then evolve it from there. But what I found is actually very helpful to save different charts from different people. So I have charts that Grayson Rose and his father Gaddis Rose sent me years ago. People like Art Hill, Tom Bowley, Greg Schnell, and others were so generous sending me ideas of how they have their login set up. Chip Anderson, our founder, as well. So all of those are what are called chart styles. And the way that the Stock Charts platform works is that you have a chart style, which is basically a template with different indicators, with a time frame, with a periodicity, and that is saved as a chart style. If you have your chart set up a certain way, all you want to do is say add new and give it a helpful name. You can see some of the ones that I use that I refer to often on the episodes of the Final Bar. Basically, that's the way that I jump around to some of those key charts that I find pretty helpful. And then the other thing I would tell you is you want to make sure that you save your favorite one as a default style. So once you have your chart set up, make sure you click Save as Default, and that would mean whenever you type a symbol here at the top of our website, it'll go to that default chart. So for me, again, the 2-year chart with all of those indicators together. Now I have other charts that I can go to next, but this gives me a consistent starting point. What amateur technical analysts do is they sort of jump from chart to chart, from indicator to indicator, just grabbing information from anywhere. What a seasoned technical analyst does is they have their go-to chart, their starting point. They have other things they might look at later, which I certainly do, but let's start all of our meals with with setting the table appropriately and having the correct chart style set up. So that's it. That is the way that that's my pro tip, I guess, for this episode, is sharing with you how I have my main chart style set up, why I selected some of those indicators, and again, the benefits of having a very systematic and disciplined way of going through the evidence. For me, it always starts with price. I would encourage you to start there. Moving averages are a really good next step, and then continue on to other indicators. I found RSI to be a good measure of momentum. Relative strength or relative performance is a great way of generating some insights about relative performance of how a stock or ETF is doing versus other levers that I could pull as an investor. The goal, I think, for you should be find the chart style that works for you. So make sure you use our chart school, the articles page on Stock Charts, to see what some of the experts are using, and also then make sure you save a default chart style to get yourself started well. That's it for today. I'm Dave Keller here with StockCharts.com. Thanks so much for tuning into this special episode of The Final Bar. We'll be back with a regular program as soon as we can. But until then, stay well, stay safe, and we'll talk to you again soon.